Hi, I'm Lindsay Biscaya. Welcome to Market Call. Brianne Gardner is on the show today. She is Senior Wealth Manager with Velocity Investment Partners at Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. The number to reach us is right here. It's toll-free, 1-855-326-6266. You can also send us an email at marketcall@bnnbloomberg.ca. And Brianne joins us now. It's good to see you. Thanks for joining us today.
Thanks for having me, Lindsay.
Okay, so let's get started here. We're looking at the last week of 2025. It's not even a full week, but what you're seeing in terms of the markets, it's a little quieter this week. Is that a surprise to you? Is that kind of what's expected to end 2025?
Yeah, I think usually, around this time of the year, we do tend to see markets be a little bit more quieter coming off the holidays, headed into the new year. And I think coming off the back of 2025, we've seen this year really be more resilient than about momentum. So for us, I think many investors expected higher interest rates to slow the economy in the U.S. much more sharply than what we've seen. Instead, we really saw the U.S. deliver a soft landing. So growth cooled enough to bring down inflation, but not enough to break earnings or consumer spending. And I think that balance is still visible today. Markets are quiet and mixed, as you mentioned, but the bigger picture around where we're headed into the new year hasn't really changed. The labor market is still holding up strong. But it's clearly cooling, which has helped ease inflation pressures without triggering a downturn. So for us, all things that we're watching, still investing, particularly around AI, which has shifted from a concept to a real spending cycle this year. And I think, what has changed is really how investors are behaving. Mm-hmm. So even with valuations as high as they are, rate cuts are being pushed further down the line. Leadership is still narrow. So where we're headed for the year ahead, I think everyone is starting to watch now.
Yeah, I wanted to get you to expand on that in terms of when you say what has changed as investors and how they're behaving. What are you seeing in terms of that behavior?
Yeah, I think this is no longer a market that we're seeing where everything is just going straight up. I think it's going to be a little bit more selective on where to allocate capital going forward and headed into 2026 and positioning that way as well. I think returns have been and are increasingly driven by executions, earning quality of businesses, and really balance sheets rather than broad multiple expansion. And I think we're seeing, similar in Canada, but a little bit more different because Canada's market had a more uneven year. But the setup has quietly been improving, I think, with how fast we saw interest rates go down in Canada. Inflation has also cooled, growth has moderated, and that uncertainty around the Bank of Canada's next move is more balanced than more restrictive. So that tends to favor companies with visibility and long-dated cash flows. So overall, again, we think that patient matters, and investors are going to be a little bit more patient headed into where they're allocating capital than predicting in 2026.
Okay, we're going to take a quick break now, but we will be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps. That's coming up right after this. Stay with us. Welcome back to Market Call. Brianne Gardner is joining us today, and we're going to start taking your questions right now, going first to an email, this one coming in from Claude, and it reads, I've owned ATD for almost 3 years now, and it's done absolutely nothing. It is my 5th largest position in my TFSA. I usually don't mind waiting for a stock to rebound when I'm collecting a decent dividend, but ATD's yield is only 1.08%. Should I take my small loss and move on to something else? Or would you recommend I stay patient? Okay, so Brianne, I'm not sure what you think about ATD, Couche-Tard. Do you think that anyone who has this right now should hold on to it?
Yeah, Couche-Tard is actually a position we own in the portfolio, but not a large weight, not similar to Claude's weighting in the TFSA there. But for us, I think it's only a moderate position, not one of our top positions. I think we have seen ATD really deliver operational stability and dividend growth, but the lack of kind of big acquisitions acquisitions, so fuel margin volatility as well, and some of that modest organic growth have really kept the stock almost range bound, as you've seen over that long run. I think analysts still see, though, long-term upside between 13 to 20% from here, but the next leg likely depends on major deal or clear acceleration in return. So demand is steady with their food sales, fuel volume soft but improving. I think we're seeing margins have a good upward trend, better merchandise mix and disciplined cost controls. So I think everything has been holding up well. So it does set it up for more of a long-term play that does look constructive, which I think is why you're seeing analysts like the stock. So global footprint expansion, loyalty programs, and that EV charging rollout, as well as the food service push. So any weakness is modestly around that fuel margin volatility we see, and timing of acquisitions, not demand. So I think the stock has been range bound for about 5 years. Big deals have stalled, and I think, again, we're giving it some more time to play out, likely taking some profits once it hits our target price, though.
Okay, so maybe others could hold on to it too. We're going to go to the phone lines now. Kevin's calling in from Kingston, Ontario, with a question. Hi, Kevin.
Hi there. Thank you for taking my call. My question's on the TD Bank. It's had a great run over the last 7-8 months, as I think most banks have, and it's still paying a very healthy dividend, almost 3.5%, and its PE ratio is only 11. And other banks, Canadian banks, their PEs are 15 and higher. Would you be stepping in and buying the TD Bank at this price? Thank you.
Okay, thanks, Kevin. Brianne, what do you think?
Yeah, great question, Kevin. And I do think, we have seen TD run up, as you can see from the chart there. All, major Canadian banks also participating in that run up as well. For us, we don't own TD. We own Royal instead, and have sold TD in the past. But from a Canadian exposure, we continue to hold Royal. I think how I see TD stacking up, let's say, against the big 5 Canadian banks, that TD has, traditionally been viewed as the U.S. growth bank among the big 5. That was really the appeal versus some of the more domesticated, focused competitors in Canada. I think that advantage has certainly faded a bit, though, and regulatory issues and strategic missteps in the U.S. has caused TD to shift the narrative from growth to almost a little bit more of damage control, but that might be behind it now. If we're looking at versus BMO, Scotia, CIBC, I mean, TD's the third best pick behind Royal and BMO, but when you put TD next to JP Morgan or some of the other big U.S. banking systems and names that we continue to hold and do actually favor U.S. financials at this time, I think JP Morgan really sets the global standard for where we want to be, and scale, risk control, and execution. So, TD is catching up, but its target price, it's at its target price already. So I wouldn't be adding at these prices. Again, I'd prefer to wait if you did want to add to TD and wait for a healthy pullback in the stock.
Okay, good to know. We're going to move on now. Chris is calling in from Delta, BC, with a question. Hi, Chris.
Oh, good morning. Thank you so much for taking my call, Brianne. Brianne, I'm not sure if you like this company called Meta. I'd just like your current thoughts on the company, and if you think that this is a good entry point for a long-term 5 to 10 year plus investment. And if I may ask, what sort of weight does Meta hold in the portfolio? Thank you both so much. Have a great day.
Okay, thank you for your question. So, Brianne, first off, thoughts on Meta and whether it's a good long-term hold?
Yes, we do own Meta, recently added actually on the pullback, and it continues to be one of our core long-term growth holdings. So, Chris, I do like Meta. I think it runs, the largest, obviously, social media platform in the world. And the key story is really their engagement in the company. So Meta now reaches, I believe it's more than 3.5 billion people daily, and their operating margins are still around 40%. So our view is that AI is reinforcing Meta's core business, even if spending stays elevated in the near term. Advertising is working better, not just growing. AI is improving how their ads are targeted and priced. helping Meta really take share even as the overall digital ad market normalizes. So the company is spending aggressively on their AI infrastructure, which pressures some of their margin short term, but the investment we see is strengthening the core ad engagement and opening new monetization paths. So again, for us, there can be some regulatory risks to heavy capital spending, but I think Meta's scale, data, and cash generation gives it room to invest through the cycle. So again, a stock that we continue to hold and want to hold longer term, at least this time. Fundamentally, it ranks a 9 out of 10 for us. Right now, we have let it run a little bit, as I mentioned, added tactically to hopefully get this pop back up. So for us, we have about a 5% weight. Again, we will look at trimming when it hits our target back to more of a neutral weight, but we are comfortable. I think you're seeing analysts, about 50 of them on the street, have it as a buy with price target upside of about 26% from here.
Okay, and you say a 5% weight. All right, we're going to move on. Elliot's calling in from Hamilton, Ontario with a question. Hi, Elliot. What's your question?
Please, good afternoon. DoorDash, the growth company, especially now that it's announced its acquisition over in Britain and Europe, I'm wondering why, when Uber, I think, is profitable, it's down in the 80s, and I think DoorDash is unprofitable, but it's up in the 230s. Am I missing something? Thank you.
Great question. Brianne, what do you think about DoorDash versus Uber?
Yeah, actually, I do prefer Uber over DoorDash. Just from a tactical play, I think there's more upside in Uber at this time. DoorDash, I don't own. It has been on our radar, though, since especially the stock has pulled back, as you can see, has had, quite a pullback since that October there. But the story right now with DoorDash is that it's no longer just a food delivery stock. It's actually trying to become a local commerce platform. So yes, food delivery is mature and competitive. There's a lot of competition on the street right now, but we see DoorDash as management is still pushing into the groceries, the convenience, to retail, to extend their growth in the marketplace. I think the market is rewarding their discipline over that growth. So investors want proof that the business can scale without burning cash. So profitability has improved enough to change that sentiment, even though margins are still thin and fragile. I think competition hasn't gone away. Obviously, Uber Eats and other keep pricing pressures high, which can, impact the stock. But the stock moves in confidence a little bit that DoorDash can keep expanding and using those cases without reigniting losses. So it's an execution story, really not a disruption story anymore. If they can continue to prove and be profitable, everyday local platform, the stock works. If not, then the valuation will become at risk.
Interesting. Okay, Brianne, thanks for that. We're going to be back with Brianne Gardner of Velocity Investment Partners at Raymond James in just a moment, taking your questions on Canadian and U.S. large cap. Stay with us. We'll be right back. Welcome back. Brianne Gardner joining us today on Market Call, taking your questions. And we're going to go to the phone line, starting with Deborah calling in from Okanagan Falls, BC, with a question. Hi, Deborah.
Oh, hi. Good morning and Happy New Year to everybody that's coming up. My question today is on Constellation Software. It really has taken a steep dive with the red candlesticks when you look at the charts. So my question to you today is, do you see this as a buy, or do you think it will drop to the $2,500 range in 2026 or even stay range bound?
Okay, thank you. Brianne, Constellation Software. We'll start with that first part of the question. Do you think this is a buy? Do you think it's going to rebound?
Yeah, we don't own Constellation Software in the portfolio, but it definitely remains a name that we follow closely given its long-term track record. And with this pullback, it has certainly gotten our attention a little bit more. Now it's fundamentally ranking actually a 10 out of 10 for us. We see Constellation that is buying small mission critical software companies that serve very specific industries. then really lets them run independently, which has historically created a steady compounding growth. The near-term story is a little bit of a pause. We've seen organic growth slowed this past quarter, really marking the weakest pace in roughly 2 years. So that makes the investors a little bit more cautious about the long-term run. I think a big overhang is the Altera acquisition, which is still, struggling to regain momentum. I think reminding the market that not every deal delivers immediately. I think M&A remains the engine of the model, but the deal activity is running about 15% behind last year, raising questions about how quickly growth can really reaccelerate. So for us, again, not a stock that we own. It's certainly on our watch list. I mean, analysts still are favoring it. The price upside from here, they expect almost 45%. For me, from an entry point, I would want to have conviction of a strong turnaround, or at least, ensure that we're not still on this downward trend from a technical standpoint before getting in. But we certainly have this stock on our watch list.
Okay, we're going to move on. Tony's calling in now from Montreal with a question. Hi, Tony.
Hi, how are you? Good morning and happy holidays. And I'd like to know on Bombardier's major comeback turnaround story, what do you think going forward?
Okay, thank you. Happy holidays to you as well. Okay, Brianne, Bombardier, they did see a bit of a comeback this year. What do you think about what we've seen? Look at this one-year chart. You can see how much that line's going up. What do you think about Bombardier for 2026?
Yeah, we have seen, Bombardier, coming back for sure. I mean, as you can see from the chart, up 143% there. Again, not a stock that we own in the portfolio, but has had a great growth story. For us, I think we just don't see the big picture, at least at this time. We would be, if I was looking to add or wanting to get in this stock, I would certainly wait for a little bit of a pullback from a technical standpoint, because we just see, this run up has been extreme and the stock has done exceptionally well. So again, not a stock that we own in the portfolio. I would be a little bit patient to be adding into it at this time, but I still see, they're engaging in that design, building, maintenance of the aircraft space. They're operating through, all of those other segments as well. And they have had, involvement in selling new aircrafts as well as pre-owned aircraft and the defense aircraft, which I think is starting to pick up pace as well, as a lot of, countries we're starting to see invest into those defensive aircraft space. So will Bombardier continue to do well? Yes, we see more upside from here, but if I'm looking to get into this position, I would wait for a little bit of a pullback before adding.
Okay, good to know. We're going to move on. Frank is calling in from Ottawa with a question. Hi, Frank.
Hi, thank you for taking my call and happy holidays. Brianne, I wanted to get your take on BAM, Brookfield Asset Management. This one hasn't done a whole lot this year. It came down recently. And with the market worries of, I think that's the reason that, the AI trade, they're investing heavily in the data center, and a lot of money is going into it. And what happens in 2026 if that reverses? I'm not sure if that is the narrative that's playing out for this one. But what do you think of from a long-term perspective? Is it a good time to pick up on some BAM? Or you prefer something else? Thank you.
Okay, thank you, Frank. Brianne, what do you think? I mean, is it AI spending and investment that's got Brookfield where it is right now?
Yeah, we own the Brookfield. There's so many, but we own the Brookfield Corp, the BN, and the BlackRock in that space. Not directly right now. We have owned in the past, but Brookfield Asset Management. I think you're seeing still a price target of about $73, so about 20% upside if it can get back up to its target. It's back to the same price it was in late 2024, but it has, as he mentioned, swung around a lot in that time. I think really what's driving is that investors are buying, fee stability, not markets, long duration, contact, like fees tied to real assets. The spinout definitely simplified the story. I think BAM is now a pure asset manager, not a capital heavy owner of assets. I think if we're looking at the private credit, the infrastructure, real assets really are exactly where institutions want exposure as public markets stay volatile. I think compared to traditional managers, though, BAM benefits from that locked up capital, so which can smooth earnings over cycles. I think versus BlackRock, though, this is a less liquid, more complex, higher upside potential, which we like, but also higher execution and sentiment risk. I think the market is rewarding clarity, but future upside does depend on that continued fundraising momentum, not financial engineering. So yes, there's still Brookfield Asset Management is a confidence play on the private markets staying in favor. So it's a clean business model now, but from here, I think returns do hinge on that flow and discipline, not on restructuring wins.
Okay. We're going to take a quick break now, but when we return, we'll take a look at Brianne's past picks. That's coming up next. Stay with us. Welcome back to Market Call. Brianne Gardner is joining us today, taking your questions. But first of all, we're going to go through some of her past picks. So, Brianne, these are from June 16th of this year, 2025. We'll start with the first one, ATS Corporation. You can see recommended at $42.33. Now it's at $38.78. So I'm assuming it didn't really do what you wanted it to do. What do you think happened here?
Yeah, I mean, I think it's still, we're letting this stock play out. It hasn't been, a full year that we've seen it. I think we see ATS that is still building the machines that build everything else. If you're thinking, from vaccines to food packaging, its automation sits quietly behind essential products that we all rely on. So the company really has focused on regulated industries like life sciences and food, where reliability matters more than price. So that's leading to longer relationships and steadier work. I think this year has been less about growing faster and more about running smarter with better products. Discipline starting to lift the margins. That's why I think we've seen analysts actually recently raise their price target on this stock to around $49. Even as the revenue growth, is expected to cool, profitability is doing more of the work now. So we have a new CEO with deep, large industrial experience that adds confidence around the tighter execution and long-term value creation. Again, I still like ATS. It's not a headline stock for a lot of people, but as automation becomes more essential, steady execution should matter more than flashy growth. Right now, we see about 25% upside from here, ranks at 8 out of 10 fundamentally. And again, we see this stock continuing to do well in the next 6 to 12 months.
Okay, your next past pick was Altius Minerals. This one was at $27.32 when it was recommended, now at $39.74. Obviously, it's dealing with minerals in Eastern Canada mostly, I believe. So do you expect more growth from this company moving forward?
Yeah, I think they have done a good job. Obviously, this year we have seen the space do well. And really the benefit that Altius has is that it's a royalty company, meaning that it gets paid from mines and power assets without having to build or operate them. For us, that low risk, high margin really model is still the core of their story. The shares are up more than 50% this year. So this is no longer a cheap or overlooked name, especially after that move. I think expectations need to be a little bit more realistic on where things can go from here. But that's where the lithium, I think, royalty acquisition matters. It adds exposure to EVs, energy storage, and really improves the long-term growth profile. So the deal brings in dozens of long life royalties, with management expecting 40 to 60 million of incremental royalties revenue by the end of the next decade. So again, I still like Altius, but I'd frame it as a hold for now or long-term compounder rather than to chase this return up. Again, we still are going to hold on to it and continue to rise profits and trim back. I think it has a high quality way to stay exposed to the resource and energy theme now, with better growth optionality than a year ago.
It seems like you're more interested, correct me if I'm wrong, before we move into your last past pick, in like long-term holds.
Yeah, I think some of our plays, we will have some tactical themed based plays where maybe, we're looking for upside potential in, a year, but other names, we're playing them, yeah, for longer term holds and for our investors. It depends on, the sector, the space where we see upside. But certainly, yes, I would say a lot of these names are going to be long term holds unless we see breakdown in the stock.
Okay, just lastly, Salesforce is your last pass pick, $263 when you recommended it, $265 now. What do you think about Salesforce?
Yeah, Salesforce hasn't played out as I had hoped at this point, but I still see the stock doing well. And I think, we could see a turnaround right now if we're looking from a technical standpoint. We could be on the run to see this stock going up from here. And we have started to see that momentum behind the price. I think Salesforce sits at the center of how companies manage consumer sales services. For many businesses, is the system that they rely on every day to run their front office. What's changed this year is execution. AI is no longer a concept at Salesforce. It's embedded into how customers actually use the platform. That's why we've been adding to the stock throughout the year. I think the adoption of AI and data products is real, with reoccurring revenue now over $1 billion. And Salesforce advantage is stickiness. Once companies run their workflows, data, and teams on Salesforce, switching becomes really costly and disruptive. Trust me, I've tried to do it and I went back to Salesforce. So, I think they've done a good job at cementing investors into that. I think their valuation remains reasonable at 22 times forward earnings, especially given improving margins and strong cash flow. So yes, we still like Salesforce. Our focus here is consistency, and I see the company is executing. Customers are adopting their AI in the real way, and that gives us confidence that we can keep building the position over time.
Okay, we're going to take another quick break, but we will be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps right after the break. Stay with us. Welcome back. Brianne Gardner joining us once again on Market Call today. Okay, Brianne, we're going to go straight to the phone lines. Joe's calling in from Montreal with a question. Hi, Joe.
Hi. I want to ask Brianna about Telus. A couple of years ago, when both Telus and TD were down, I took positions in both. Unfortunately, I chose Telus for my TFSA. And I want to ask what her thoughts are on the company. Will they bounce back? And if she thinks I should sell, where would I put it to kind of get back my losses? I'd appreciate your help. Thank you.
Okay, thanks, Joe. Yeah, Brianne, you can see this one-year chart, that sharp drop by the end of this year. What do you think happened with Telus?
Yeah, Telus, I think we're going to see a turnaround story. When that story does happen, though, it's a little bit of a timing game. I think they're still one of Canada's and continue to be largest telecom providers, right? So they're selling wireless, internet, TV services that people use every day. I think the wireless competition remains intense, though, and it's really pressuring pricing. And Telus, we have seen their stock impacted by that as well. But Telus, I see too, is offsetting some of that by growing its health and digital services business, which is great. Telus Health, if you haven't used it. Management recently decided not to increase the dividend. I know a lot of investors, and has been a widely talk on, is Telus going to cut their dividend? We saw they'll cut their dividend. So now we're seeing their dividend now around that 9% dividend yield. I mean, for a telco company that isn't going anywhere, and you're collecting almost a double-digit yield from that, we continue to hold the stock because we are getting that income from it for especially retirees. Yes, the price fluctuation, if you did have cash on the sidelines, it's not a bad time to add, but choosing that instead to protect the cash flow of them not choosing to increase their dividend, I think was a strong strategic play from Telus. And that showed that their balance sheet flexibility, which we see a disciplined move in this environment. So the stock still cash generating, remains solid. That allows Telus to keep investing in its network while maintaining the dividend, even as growth stay modest. So ranks about a 9 out of a 10 from a value score. And analysts from here see about about 26, 27% upside from here. So I'd be a little bit patient on this stock, give it another 12 to 24 months, and I think you can see a turnaround.
Okay, it's good news for Joe, at least. We're going to move on. Walter's calling in from Ottawa with a question. Hi, Walter.
Hi, Bank of America, buy, sell, or hold. Thank you.
Okay, thank you. Bank of America, what do you think?
Yeah, Bank of America. I mean, I think that stock, is in the U.S. financial space. We have seen, a consistent run up, as you can see from looking at the chart there, and has done well over the last at least 12 months too. Do we want to be adding at these levels? I'd be patient on it. I think the U.S. financials, we still prefer names that we own, like JP Morgan or BlackRock, a little bit more consistent capital flexibility and lower sensitivity to the economic cycle. But that said, Bank of America still remains a core U.S. banking franchise. I think they have broad exposure across consumer banking, wealth management, and capital markets. The recent results showed momentum across that business with strength in both traditional lending and trading as their market activity stays elevated. They have done a good job with their cost and capital discipline that has been solid, that helps support their earnings even if growth slowed. So the trade-off really is the macro sensitivity as results remain exposed to interest rates and the broader economic backdrop. So again, I'd say continue to hold Bank of America at this time, not a stock that we do own, but still you have that stability out of the U.S. financial markets.
So a hold in your opinion. Okay, we're going to move on now. Alfred's calling in from Mountain View, California. Hi, Alfred.
Yeah, hi. Thank you for taking my call. Your take on Berkshire Hathaway, I own that stock, and one of the reasons I like it is because the tax advantage is that they do not pay dividends, and they only concentrate on new acquisitions and so forth. I appreciate your take on it. Thanks.
Okay, thank you. Brianne, what do you think about Berkshire Hathaway?
Yeah, I mean, Berkshire Hathaway, the target price right now is only about 3% higher than where it's currently trading. And a few analysts actually have it as a sell or underperformer, meaning the index is expected to beat it. For us, I see really what's driving the story is that it's being treated less like a stock and more like a safe haven equity, so to say, in an uncertain market. So investors like the simplicity, cash rich, balance sheet, diversified earnings, and no resilience on market timing. I think the portfolio we see leaning towards quality businesses that generate steady cash, which plays well when growth gets choppy. Management discipline matters here, though. Berkshire doesn't chase trends, and that restraint is really part of the appeal of the stock. I think the market also sees optionality in the massive cash piles that they have, even with deployment, has been patient. At these levels, the stock really reflects trust and durability, not excitement or aggressive growth. So this works when investors want stability, this stock, when they want capital preservation and long-term compounding. It's not about the next quarter. It's about the confidence that this stock and this machine keeps working regardless of the cycle. So again, I think you're still going to see momentum out of Berkshire, but it's not going to be a huge growth story that you're going to expect.
Okay, thanks for that. We're going to move on. Amy is calling in from Toronto with a question. Hi, Amy.
Oh, hi again. My question is on the stock symbol, GFL. I think it's called, what the full name is the Environmental Solutions Company. The stock has fell a little bit. I don't know if it's a good time to get in or just want to watch a little bit. Thank you for your advice. I'll hang up. Thank you.
Okay, thanks, Amy. So, Brianne, what do you think about GFL Environmental? Would this be a good time to get in? You can see how much it's dipped by the end of this year.
Yeah, we've certainly seen a pullback in this stock. If you're looking at adding, again, I would be patient to look for a conviction of a turnaround in here. I don't own GFL. We have indirect exposure to the space, though, through Waste Management and Republic Services. The stock has never hit analyst targets over the last 5 years. So for me, that tells me that there's a lot of people that are a little bit overly optimistic on this stock. That said, analysts do seem to be positive. GFL is still being treated as a roll-up in transition, not a finished compounder. The company grew very quickly through acquisition acquisitions, which built scale, but also left investors focused on leverage and integration risk. I think management has shifted the narrative from growth to deleveraging and simplification. And that has helped sentiment. Unlike Waste Management or Republic, GFL hasn't fully earned the sleep at night stock multiple yet, so to say, with that volatility. The business itself is solid, though. Waste is non-cyclical and pricing is resilient, but execution matters more here. I think the stock moves when investors believe debt is coming down steadily and operations are getting cleaner. We will see that turnaround story. So a little bit of a work in progress right now of a great business model, but until leverage is clearly behind them, I think we prefer more predictable, fully matured operators in the waste space.
Okay, we're going to take another quick break here, but we will, of course, be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps right after the break. Here's how you can reach us. Welcome back to Market Call. Brianne joining us once again, taking your questions, and we're going to go to the phone lines. Jim is calling in from Peace River, Alberta, with a question. Hi, Jim.
Hi, thank you for taking my call. In January, come TFSA season, I'm considering natural gas. Which would you like better, Peyto or Tourmaline, please? Thank you very much.
Okay, thanks for your question. Okay, two big competitors, Brianne. Which one do you like better?
Yeah, I mean, you can see certainly the split there. We have actually recently, we don't own Peyto. We have looked at and have now a small position in Tourmaline we picked up. Just to get a little bit of exposure, we think, again, with this gap here, there is an opportunity for Tourmaline to play a little bit of catch up. I think both are a little bit higher torque, right? Higher beta energy stocks. Peyto is at analyst targets now after a recent run higher, whereas Tourmaline has pretty much flatlined for the last couple of years. And so have analyst expectation, but it still has potential. I think how we see the two stack up against each other is we think Peyto as the income first, almost gas producer, lean, disciplined, and built to throw off some cash when gas prices cooperate. Tourmaline is the scale and quality story. So think bigger inventory, better balance sheet, more flexibility across cycles. Peyto does tend to work best when natural gas prices rise quickly, but it gives back gains when that just as fast we see prices soften. So Tourmaline doesn't spike as hard as you can see from the stock price comparison, but I think investors really trust the name, its cost structure, and capital discipline. In a weak gas markets, Tourmaline plays defensive a little bit better, and Peyto feels the pressure more accurately. So big picture, I think Peyto is a gas price trade that has already hit its target, where Tourmaline is a multi-cycle compounder that has taken a breather, certainly, but we think that it has 15 to 20% upside potential from here. So for me, we would look at adding Tourmaline at these levels.
Okay, thanks for that. Mark is calling in now from Ottawa with a question. Hi, Mark.
Hi. Happy holidays, ladies. I'd like to know your long-term outlook on Northland Power. Of course, I bought it like 5 years ago at its peak. I really like the new CEO, Christine Healy, and I think from them cutting the dividend on our last reports is a good long-term strategic move. I appreciate your comments. Thank you. Bye-bye.
Okay, thanks, Mark. So Northland Power, yeah, it's seen a bit of a shift since November. You think still a good long-term hold?
Yeah, thanks for the question, Mark. We don't own Northland Power in the portfolio right now. I think, you're still seeing Northland Power is a global clean power producer, right? So wind, solar, storage, natural gas assets, most of really which are backed by long-term contracts. The near term has been a little bit difficult for Northland and the stock. I think offshore winds have delayed and hurt their confidence. That forced a reset in expectations and led to a roughly 40% dividend cut. So with the stock falling about, we saw from that peak, 23% after that announcement. Yes, painful, but likely necessary to protect the company's balance sheet. I think what rather matters here now is that management has laid out a new 5-year plan that focuses on disciplined growth, higher return hurdles, and funding projects without issuing equity. So a long-term backdrop is still supportive for the company, driven by electrification and clean energy demand. But again, for me, I'd like to see a little bit more consistent execution before considering this stock. So do I see upside from here? Certainly. And I think so do analysts. You're seeing it rank about a 9 out of 10 fundamentally and about 23-24% upside from here.
Okay. Now we're going to go to the phone lines once again. Pete is calling in from Victoria with a question. Hi, Pete.
Hi there. Hello, ladies, and thanks for taking the call. Happy New Year. Brianne, just wondering your thoughts on MDA Space.
All right. Thank you, Pete. Yeah, MDA Space has had quite the year. Brianne, what do you think about this company?
Yeah, we don't own it, but it's certainly a company we've been following. They build satellites, robotics, space systems, really for governments and commercial missions. There's some excitement really over the space race again, and companies involved in the industry can certainly see some of that overexcitement by investors. I think, you've seen this rally upwards, and this price spike really was fueled by optimism over their backlog and also some sector hype. So the crash that we originally saw came from timing risk, debt worries, and a valuation reality check. But fundamentals in this still remain solid. I think the next leg depends on almost flawless execution and Constellation ramp up. So demand is strong with major government programs we've seen coming out and other contracts driving a big backlog. Margins are healthy, but really that debt funded expansion adds pressure. So I think long-term setup does look constructive, but they have to deliver. So leveraging is rising over $250 million in debt issues. Any weakness is timing and execution, not demand. So the stock spiked again on that mega contract win, then corrected as growth expectation came back to reality. For me, I wait to see execution on their backlog before considering a position.
Okay, good to know. We're going to take another quick break right now, but when we return, we'll take a look at Brianne's new top picks. That's right after the break. Stay with us. Join us tomorrow on Market Call. Mike Philbrick will be on the show. He is CEO of Resolve Asset Management, and we'll be taking your questions on exchange-traded funds. Okay, and Brianne Gardner joining us once again today on Market Call. We're going to go through her top picks to end the year. Brianne, so we'll start with your first one, WSP Global. And you say you like this because of the visibility when it comes to long-term work for this company?
Yeah, exactly, Lindsay. I think we've seen WSP is a really global engineering and consulting firm involved in major infrastructure, power, and environmental projects around the world. With this little pullback that we've seen in the stock, I see some upside from here. And really what I like, as you mentioned, is the visibility. Governments and utilities plan years ahead, which gives WSP a steady pipeline of work even when economic growth slows. That stability is showing up in their results. Management recently raised its net revenue outlook to roughly $14 billion. That shows me a strong demand across regions. I think strategically, WSP continues to look for ways to scale. Recently, they did a takeover chatter about the Jacobs that has been going on. I think highlights their ambition, and it also deepens its U.S. presence and capabilities. Analysts have a modestly raised their value to about 329, reflecting confidence in their execution. I like WSP as part of our portfolio. It's a high-quality compounder with strong visibility, offering durable exposure to long-cycle infrastructure spending.
Okay, good to know. Your next one is a Costco. Costco saw a bit of a pullback to end the year, actually, but still looking pretty good despite a bit of a volatile year, I think.
Yeah, exactly. And I think a lot of people, thought of Costco too, that safe bet. They have, the hot dog that has never increased their prices. And still, Costco is one of the most consistent businesses, I think, in the global retail. Its membership model is really their core driver of loyalty, reoccurring revenue, and steady traffic that is hard to even replicate. So even with a tougher consumer backdrop, Costco continues to gain share price because shoppers trust its price pricing, quality, and value. Their membership base is the engine. Renewal rates around 90% and growth in the higher tier membership support that predictability of cash flow and long-term compounding. So as you mentioned, Lindsay, with this pullback, I see it as, a key advantage to get an entry point in Costco. Their supply chain helps to manage their costs better than their peers. Valuation, yes, is about 50 times forward earnings, but that premium reflects their durability and reliability rather than hype. That's why Costco remains a top pick for us. It's a business that compounds through cycles and has that downside protection. So we see double-digit up over 20% growth from here and ranks a 10 out of 10 fundamentally from a score for us.
Yeah, Costco is just such loyalty among its customers. It's pretty wild to see. Okay, your last pick for this year is Broadcom. Bit of a bright future for this company, although it does have a lot of competition.
Definitely a lot of competition. I think they do sit at the center of the AI infrastructure build-out, supplying, their custom chips and network that power large data centers. Again, we have seen a little bit of a pullback, even from a technical standpoint. It looks to have a strong support there. What sets Broadcom apart is their customization. Designing chips alongside its biggest customers creates deep, sticky relationships and long-term demand. And that demand is real. Right? AI-related revenue is now growing at roughly 30% annually, driven by large-scale deployments rather than experiments. So Broadcom also isn't just an AI story, it's a software business. So they bring in reoccurring revenue and help smooth the semiconductor cycle. There are risks, of course, including AI customer concentration, as you mentioned, Lindsay, and some margin volatility. But Broadcom's role as a core infrastructure ties demand to overall AI spending, not any single customer or model, which is positive. So overall, we still like Broadcom because it benefits from the AI workloads scaling by a record backlog of about $110 billion. So we see 32% upside from here. Their 1 year revenue, we've seen about 23%, and earnings growth annualized 1 year, 286% growth, and ranks a full 10 out of 10 for us from a fundamental score.
Just quickly before we let you go, it can be difficult to pick a company in this sector that deals with semiconductors and chips when there is so much competition, like I mentioned.
Certainly. And I think, we look at, competition risk, what stands a company apart, how safe is their cash flow, right? Is it reoccurring? Is it dependent on one partner? Are they in that cycle loop like a lot of the other companies like ChatGPT, et cetera, in that AI circle? And Broadcom isn't, right? We see a price target of about $460 per share. And we've seen, even if we look at the stock returns, 3 months, 6 months, 12 months, 6 months up 38, 12 months up over 50%. And again, why we still think Broadcom is going to be a strong performer headed into 2026.
Okay, Brianne, so good to have you today. Thanks so much for joining us. Happy holidays. Happy New Year. We'll see you in 2026.
Thanks so much, Lindsay. Happy holidays to you.
And thanks for watching Market Call. We'll see you next time.